Welcome everybody to today's preview of the Savvy Tax Planning School for Financial Advisors, the in-person two-day workshop that's coming up in New York City on November 2nd and the 3rd. Today, we're going to be hearing from Debra Taylor, one of the co-leaders of the workshop, along with Jeffrey Levine, about what advisors will be learning over the 2 days and how adding a tax focus can build client loyalty, referrals, and profits. If you want to go ahead and learn more and get all the details about the workshop or sign up, you can go to horsesmouth.com/tax school. You can find the link to that in the description beneath the player of wherever you're watching today's stream. Alrighty, to kick off today's preview, I'll turn things over to Horse's Mouth Editor-in-Chief, Sean Bailey.
Thanks, Doug, and everybody out there, thanks for watching. We appreciate it. Debbie, great to see you again. It's always fun to get together and talk taxes with you. So I have a question for you right off the bat. It's like, why should advisors, advisors work in retirement planning and investments? Why should they take on, you refer to this area as sort of like family tax guidance, right? Why should advisors take this on? They're already doing the retirement. They're already doing investments. Why this?
Because clients need it. How's that to start?
What, don't they have accountants?
They do, but we know that most tax preparers are not doing this work. And, it's funny, there was just an article, I didn't get a chance to read it fully, but I saw the headline, and they said there's like more middle-class millionaires today with their 401ks than ever before. Sean, you and I have been talking about, I'm looking down because, now I'm like, okay, where's that article? But Sean, you and I have been talking about this, as I've been saying, anecdotally, I'm seeing more clients coming to us that are just solid Americans, is what I call it, right? Not a fancy doctor, not a CEO of a company, but more folks that got a little bit lucky, lived within their means, and rode this 10, 11-year bull market. And so we have more and more clients today with these huge retirement account balances, and the taxes on them are tricky. It's not a large taxable account where you have some capital gains and capital gains are low and, everybody is sort of okay. It's a lot more complicated. And that's where all the money is in these large retirement accounts. So the short answer, though, to your question is, why do this? Because your clients need it. I can add to that, right? Clients need it. It will help you bring on clients and close them. It will help you bring on and retain larger clients who feel confident in the investment management area, but don't feel confident in the tax planning area. It will help you justify and protect your 1% fee like nothing else, like never before. And something, it feels good to make a difference in clients' lives and do something for them that they really need. So that's the long answer.
Oh, okay. Well, I think it comes waterfront there. We might as well just end. But, speak a little more about, advisors have competition, lots of people in this space. This is a sort of retiree niche, so to speak, if you loosely define niche. So there is this idea that advisors need to be able to differentiate themselves from, the guys across town. And tell us how you have been able to use this family tax planning as a differentiator.
Well, because the guys across town, for the most part, are not doing this work. So I'll give you an example. As I was in the Upper East Side earlier this week, meeting with a client that was referred to me. The client was interviewing one of those huge RIAs that's listed in the top 10 of Barron's. And we're going to win that business. And we're going to win the business because that huge RIA that's top 10 Barron's is not doing this work, and the client needs this work. So this is a huge differentiator. Now, look, maybe 5 or 10 years from now, maybe it won't be such a huge differentiator because the technology and the marketplace will have caught up. But something, I'm going to ride this wave for the next 5 or 10 years. And, think of it this way, is probably 20 years ago, well, not probably, it was, right? Sean, if you remember when you first started doing some of this, oh, excuse me. This is my daughter. Thought I shouldn't shut that off. If you remember about 20 years ago, and I do remember doing this, we did financial plans for clients. And it was sort of cutting edge to do that back then. The software was a little bit clunky. It was a very new concept, but we did that. And again, part of that was my CPA background. I was like, yeah, like people absolutely need it. Right, exactly. Like, what are you kidding? Right? We absolutely need to be doing this. So to me, very intuitively, we should be doing this. Now, I'm not going to tell you we did a great job because, again, the technology wasn't quite there. And even the way clients thought about it, right? But we were doing it, and it was somewhat revolutionary. Now, fast forward, by the way, there's still a lot of people that aren't doing plans for their clients. I mean, I don't even know about that. But anyway, fast forward 20 years, and it's become somewhat expected. It is sort of a sine qua non. Yes, we should be doing this for our valued clients. And now there's so many software options and ways to approach it that anyone who's like, oh, yes, I use Excel, which, by the way, 20 years ago, that was a very acceptable way to approach this, right? And today you're like, oh, no, we have, Money Guide Pro, we have eMoney, we have Right Capital, right? We have Asset Map, right? Like, think about all the ways you can do this. I think, and that's the accumulation planning, by the way, right? That's what that software focuses on. I think of what we're talking about now in the same way is perhaps the next 20 years could be starting off like this, where horse's mouth is in the lead. Debbie and Jeff are teaching these classes. Debbie's writing all these articles. Jeff is obviously speaking and writing also and here and in other places, right? And it's sort of cutting edge. And people are a little skeptical. And even advisors are like, why do I need to do that? That's just extra work for me, right? Think about it. 20 years ago, they were saying the same thing about doing planning, right? And clients weren't really expecting it 20 years ago. So the advisors that did it were really going above and beyond. It's really the same thing today. And maybe 20 years from now, it will become such a part of the profession as financial planning accumulation strategies is now, if that makes sense to you. Yeah. So anyway, those are my thoughts on it. But having said that, Sean, just as 20 years ago, I started doing planning for clients because it was the right thing and it enabled me to attract clients and keep them. Today, this next thing for these larger clients is doing this distribution planning.
Right. Good. So let's take a couple of your client success stories, and don't give us the people on the Upper East Side with the massive apartments overlooking Central Park. I know not all your clients are like that, but give us a thumbnail story or two of how working with clients has really made a difference in that family's future and their financial well-being. Yeah.
And just as an aside, I mean, obviously I talk about some of those stories because they're more impactful. I'm not like trying to brag or anything, but yeah. So some of the like the clients, right, is what comes to mind is like that widow that comes to you, or that couple where a traditional couple where the husband is a little bit older, likely to pass before the wife, right? Maybe there's a big age difference, or maybe he's not in great health. And you coming in and doing some of this tax planning for them can be really powerful. So think about it now, is they come to you and they already have an advisor, but the advisor is not thinking about tax stuff, right? They're just doing their investment management stuff. And he's 10 or 15 years older, which, by the way, is much more common, right, than people realize. And maybe he's not even good health. But everything is in her name or half of it's in her name. Just a simple transferring the appreciated assets, right, in the taxable account, just transferring it to his name and letting him pass so that she can get the step up in basis. Like, such a simple thing. But if they're holding on to Apple and technology, which so many folks are, I mean, that could save them hundreds of thousands of dollars in future taxes. The simplest thing in the world. And I can't tell you how many clients come to us where, he's older, again, sort of traditional profile. He's older, he's infirm, we know he's not doing well. And all the assets are in her name or half of them in her name because they're like, oh, we split it down the middle. And I'm like, well, that's not a great idea, right? So it just such a simple thing could be literally hundreds of thousands of dollars or millions, but I'm not allowed to talk about that.
It'll become $1 million with a few years under your management.
Yes. All right. So that's one example, right? And we've done that for clients, by the way. Okay. We've done that for clients and like super impactful. And we've done it at the smaller end and of course done it at the much larger end, which I'm not allowed to talk about. Okay, then also some of that Roth conversion planning, again, married filing joint, but we know that, there's going to be a change and she's going to be single. And so let's do some of this Roth conversion work while you're married filing joint, because next year when you're filing single, or maybe 2 or 3 years from now when you're filing single, these incomes in the tax bracket are literally cut in half, and doing all this Roth conversions is not going to be nearly as attractive to you in 2 or 3 years as it is today. So those are two just super basic examples of just the power of this.
Right. So, sometimes when we're dealing with clients or we're just dealing in, any sort of situation where you're around the table with other people and, you're able to drop a, super powerful bomb of value, that people recognize you've said something, you've offered an idea or an insight, and people, respond. How does it feel for you? How does it feel for the advisor when you're, engaging both prospects and your clients around this sort of stuff? And the light bulb goes off in their head that, oh, all right, Debbie really gets it, and now I'm getting it, and oh, she's smart. This is a good thing.
Don't let the secret out, Sean. Yeah, I mean, it's something. It's a really, like you say, it's like an aha moment, and it is really groundbreaking, right? Because what happens a lot of times these days is people come and they feel like they know it all. Okay, particularly now that the market is back up again. They're like, yeah, I knew we should hold on to Apple. I knew that would come back. I knew Amazon was the right thing, right? So people are coming with a little bit of bravado, feeling really good about the work they've done. And look, yes, they should feel good, right? If they've amassed some money, good, that's great. But most of them are not aware of the intricacies, the nuances of the tax laws. And so as strong as they can be in one area, they are equally weak in this other very important area. So when we sit, sometimes, particularly if they've been referred to me, but even if they're coming on their own, there's a certain pride, certain protectiveness. And they're like, well, like this is a couple I was meeting earlier this week. And he was like, yeah, I think we've done a really good job with the assets. We're buy and hold. We don't need to make any changes. We're really good here. And I must hear that at least, I don't know, half to 2/3 of the time, right? So think about it. If your only pitch is investment management, then at least in my experience, half to 2/3 of the time, the people you're meeting with basically tell you they don't need you, right? And so the presumption is really against you and really hard to overcome that presumption. But if they show up and they're like, yeah, this investment management thing, I got it down. So I'm sort of like, don't even know why I'm here, but like, I'm here. What do you have to say? And I'm like, oh, investment management. And I might make a few mentions of things, but then I will focus on the planning and then the tax part of it. And I can tell you right now, most of them on a scale of 1 to 10, if you're grading their knowledge, they're 1 or a 2. Okay, they're 1 or a 2. It's just too complex for them. And so that's when then we start talking widow's penalty, TCJA expiring, like all this stuff. And now they're like, wow, like I didn't realize that this was stuff that was out there. I didn't realize I needed it. Or sometimes I'll be like, yeah, I read about that, but I didn't really know how to put it together. At the end of the day, you are adding value, right? At the end of the day, you're adding value because even the ones who read about it don't know how to execute. So it's actually fascinating because they'll be like, again, a little know-it-all-ish, right? And they'll be like, yeah, I know about those Roth conversions. And I'm like, okay. Meanwhile, I see that they only have like $30,000 in a Roth account. So I'll be like, oh, and so like, what have you done? And it's like, well, I wasn't really quite sure. I was going to deal with it next year. They don't know. They don't know how to execute. So yeah, it's like you can like read on a website how to build an atomic bomb. I mean, you can like read that stuff, right? Mm-hmm. You could probably read how to do a surgery on somebody's arm, but like when it comes time to do it, you're going to like pull out that scalpel? No, same thing.
Right. Good. All right. So, as you've gotten into this area, what's something that when you first were getting into this and your eyes were opened about it? Yes, I know you come from a CPA background, so this may be a little more difficult, but nonetheless, what is something that, you yourself have looked at in the tax space in recent years and said, wow, every advisor ought to know this, but they don't.
Yeah, what I would say, Sean, is that the rules of thumb are reflective of very limiting thinking. And the rules of thumb came around at a time where we didn't have the technology, we didn't have the resources to be super thoughtful. And so we were sort of winging it. And what I see today, and I wrote an article about this, which I think was published in the last month or so, is what I see today is too many advisors are still navigating. I'm coming up with this is going to be some good metaphors here. Too many advisors are still navigating, like by the moon or by some rudimentary compass. Mm-hmm. And the clients lose. And by the way, the advisors lose also, because you're not able to bring the value to the clients, and therefore you're not able to charge, right? You're not able to get that prospect to sign on with you or get that client to stay with you or bring you additional assets. And so I would tell you, like, looking back at the evolution in the last couple of years, and it's been so profound the last 2 or 3 years, right? Is what I would tell you is advisors are still not getting that the rules, the conventional wisdom do not make sense anymore.
Yeah, I like that. And my mind is playing around with a shorter, punchier title for something that is something like, when the rules of thumb get stuck in your eye or something like that.
I like that.
Something. We'll work on that and come back to it. But
just, Sean, let me mention, it's amazing how many things work that you don't think would work, right? Oh, like, what if I did a Roth conversion and he's like 90 years old, right? And the rules of thumb would be like, well, you shouldn't do that, right? And then it works. And I don't mean it works like, oh, yes, I can do a Roth conversion. No, I mean, like, the numbers work. Like, it will make sense to do that. And so that's what's so amazing, is when you really try these things out, the rules of thumb would tell you, do not do this, and yet they can work.
Yeah, right. Rules of thumb. Good. All right. So, we're together here because we're talking about, the upcoming workshop. It's going to be in November 2, 3 in New York City, live and in person. What a great time of the year to be in New York. It's, cool and crisp. The snows haven't come yet. The leaves are still falling, and we're all going to be there live in New York City. So stay posted. It's not until November, but there are opportunities for you to get in and save some money by registering early. So Doug Pierce will make the link available. Look below if you're watching this on the recording. If you're live, take a look in the chat box. And Debbie, thanks for being here. We'll be back soon to talk more about the Savvy Tax Planning Workshop and what advisors are going to learn when they come to New York City, November 2nd and 3rd, live and in person. Jeff Levine and Debbie Taylor. So everyone, have a good night.